Hello and welcome everybody to this first II Nordic Forum. It's great to see you all here. I'm joined as ever by Gary Robinson, our commercial director, and together with our various sponsors and panelists, we'll be discussing topics as wide-ranging as cloud computing, natural resource investing, and the return of the emerging market consumer.
Thank you very much. Thank you everyone for taking the time this morning. As stated, we're going to be talking a bit about cloud computing for 10 to 15 minutes here. In looking at the space, and it's sort of an auspicious time to be reminding people that cloud computing, in at least WisdomTree's view, is a long-term mega trend. What we're showing on the page here, we work with an expert partner in the space. That expert partner we're going to see is actually involved in the security selection process of the actual cloud companies, but the benefit of working with a venture capitalist that has a specialty on cloud computing is periodically they put out different outlooks. And last year, in April of 2020, they put out what they called their State of the Cloud report, their State of the Cloud outlook. And this was my favorite chart from that outlook. The blue that you see growing as you go from left to right is telling us a greater and greater proportion of enterprise software should be cloud-based as we go from, say, 2020 to 2030. And the bar specifically in 2030 is positing that 83%, roughly speaking, could be cloud-based enterprise software by the time we get to 2030. And just to give people context, the size of sort of the enterprise IT spending that is currently in place is about $4 trillion US. So it's already a rather large pie. The pie itself is growing, and then cloud computing is increasing in share of that pie. And they were putting together this forecast, Bessemer Venture Partners, which we're going to go into, that's our expert partner. They were putting this together before COVID-19, before we knew, if it was published in April 2020, we didn't know in April 2020, or even the few months before, that a year forward, we would still essentially be in at least a very similar situation with various degrees of lockdowns occurring month by month for the course of 12 or 13 months at this point. And so what's represented on the page is really something that's pre-COVID. In many ways, COVID has pulled forward the digital transformation decision of many firms. It, in some ways, has maybe also pulled forward some of the stock price performance, at least if you look at the 2020 returns. And so ultimately, we always bring people back to this idea of it's not about 2020 by itself. It's not about 2021 by itself. It's about the journey that we're on between now and 2030. Now, it's nice to look at a forecast. A forecast might be true. It might be close to true. It might be totally wrong. It's a forecast. You really just don't know. It's also nice to look at what we have now on the page, which is actual historical data. And so this I took from a Wall Street Journal article. The darker blue is basically the on-premises spending, the idea that there's the server in the closet or in the basement, and the company is using everything itself on premises. The lighter blue is the cloud spending. And you could see in 2009, 3 years after essentially the inception, I believe, of Amazon Web Services, which was around 2006, the spending was, you really have to get a microscope out to look and see the height of the light blue bar. But you get to 2019, and in a short decade, you've now equilibrated the two. And even cloud is a little bit ahead. So it's telling us that what we saw in the prior forecast, at least based on what we can see over the past 10 years, is there is potential there. There has already been growth. Companies are adopting these approaches. And again, this forecast is up to 2019. I haven't seen the 2020 data. So this has occurred, again, before anything that we learned from the COVID-19 pandemic period. It's also notable to just think in terms of scale. There are two very, very large players in infrastructure services, infrastructure as a service, it tends to be called. You have Amazon Web Services and you have Microsoft Azure. And it's notable to compare on a quarterly revenue basis, Amazon Web Services versus Google, just to, again, ground ourselves in the benefit that Amazon sort of took a hold of by being that first mover and investing all those years into this space. The market share of Amazon Web Services is roughly 45% or so of the global public cloud. When you think of how WisdomTree structures the investment strategy and the investment thesis for such an approach, you see on the bottom, I already mentioned them, Bessemer Venture Partners. This is a venture capitalist, global in nature, and there are partners there that have been dealing with cloud and have been entrepreneurs themselves within the cloud going back to the late 90s, early 2000s. So basically as far back as you could possibly go due to the proliferation of high-speed internet, you've had people at Bessemer that have been dealing with cloud. So that's the deep expertise they're bringing. NASDAQ is essentially the third party that calculates the index, and then WisdomTree is issuing the specific investment vehicle. The key of all those things, the most interesting, is what is it that Bessemer is actually doing? They are selecting the underlying constituents for inclusion in the index 2 times per year. They do this in February, so they just did it. We're going to look at those results, and they do this in August. So every February and every August, Bessemer is monitoring the space, applying their expertise, selecting companies. The upper section of the slide, that part of the selection is they want to focus on pure play cloud exposure. They want to ensure that every company that represents a diversified business is getting more than 50% of its revenue from cloud-based services that they are selling. The other aspect here is it's business-oriented software products. So clients have asked us in the past, do you include Netflix? Where is Spotify? They don't see them on the list. There's 58 companies currently on the list. Why don't you see the entertainment companies? We're not saying the entertainment companies are wrong or bad or will have low returns. We're simply saying, if you look at how this investment tool and the toolkit works, we focus on business-oriented software firms. The other thing that Bessemer does is they're looking at revenue growth. They want to ensure at least 15% revenue growth for the last 2 full fiscal years for any company. So companies have had to prove that they can grow revenue prior to gaining inclusion. Existing constituents, at least 7% in one of the last 2 full fiscal years. Now, when you do the approach, you go through all the steps and you create the index and rebalance the index twice per year. You're always going from something that's going to look like the blue dots. The blue represents on the vertical axis the weight in the index, and the horizontal axis represents essentially the 6-month return. And so you look at Sprout Social. Sprout Social has a bigger weight because its return for the 6-month period was really high. And we know this. 2020 was basically the year of cloud, at least in recent history. So there were definitely companies like Sprout Social, like CrowdStrike, like Cloudflare, that in a 6-month period, towards the end of 2020, beginning of 2021, you did see triple-digit returns. And earlier in 2020, it was different companies that were generating triple-digit returns, but they were certainly there. And similarly, SVMK, that's SurveyMonkey, I had to look that up initially myself. That represents a company lower weight, worse return over that particular 6-month period. So the first thing that happens at the rebalance is you're bringing everything back to equal weight. The second thing that happens at the rebalance is you would start including the green companies, because these are companies. Snowflake was a big one. So many people may not have heard, myself included, of many of these other listings until they were in the index. But Snowflake, you had to be sleeping under a rock on September 16th, 2020 to not hear about Snowflake. I think the market capitalization doubled on the first day. Warren Buffett was involved. It was an unbelievable blockbuster IPO. And so the nice thing about this approach is you do have a proliferation of companies that have very recently listed their shares on public markets. Each of the 7 green dots was not public a year ago today. So you're getting an early exposure to the underlying companies. And I would note the reason why the gray is not exactly equal weight is this is actually the closing price after the first day of trading. So it would have opened the market exactly equal weight. Some of these names can be quite volatile. So even closing on the first day, they don't exactly look equal. And then finally, the red are the companies that are deleted. Slack is the quintessential example there. I think it was December, the $27 billion acquisition announcement by Salesforce came to be. And because each of these companies is involved in its sort of own acquisition process that is public information, you essentially would not include those companies going forward. The result of this process, running it as we do, and it's notable in my one-to-one client calls, we talk a lot about why is Microsoft not there and why is Amazon not there. It's not because they're not big players in cloud. Microsoft gets about 35% of its total revenue from cloud. Amazon gets 10 to 12% of its total revenue from cloud. And so that's not more than 50%. We made a decision. Part of the reason for that decision you see on the page, namely low overlap against major benchmarks. If people want Amazon and they want Microsoft, there are many options that will get them that exact exposure. They don't need to go to a unique cloud approach to get exposure to some of the biggest companies in the world. We wanted to differentiate. We wanted to give people pure play cloud exposure. And our decision alongside Bessemer was 50% or more of underlying company revenue must come from the cloud to be included. The result, as you see on the page, very low overlap against common things that people use. And essentially the final point that we would make today is 2020 was a big year. You see it right there on the page. The BVP NASDAQ Emerging Cloud Index, that's the strategy we're talking about, 110% roughly speaking returns in 2020. There has definitely been some volatility of late. These stocks, many of them, the valuations went up significantly after such high returns. And when now Jerome Powell speaks and when the US Treasury yield curve changes and interest rates go up, there is a reaction in these stocks. That's why we keep thinking and keep reminding people of the long-term trend, the long-term push that many of companies are making towards cloud. There's one thing to try to predict what the next 3 months, 6 months, or 12 months might bring. I admit that's a very, very hard game to be in. But you look at the underlying fundamentals, we're seeing revenue growth in the range of 30 to 40% in terms of underlying sustainable fundamental growth figures looking forward on, say, a 5-year basis, which is really the best you can at least come up with a reasonable forecast of. So what we were seeing last year with 350% plus year-over-year revenue growth for Zoom, that is probably not going to continue. And things are going to equilibrate back down towards 40 or so percent. Zoom has given guidance for the current fiscal year that revenue growth should be more in line with a 40-ish percent figure and not a 350% figure that we saw. So it might be a bit of a transition period right now. Could be a buying opportunity if, again, you believe in where we're going by the time we get to 2030. And so with that, I can pause and open it up for any questions.
Chris, thank you very much. That's a really interesting discussion you've already opened up there. I'm just looking to see if we've got any. We don't have any questions in just yet from the audience. I have a couple. Okay. Today the focus was largely on cloud computing, of course. I just wondered more widely at WisdomTree, what other thematic strategies you have on the go?
It's a great point. WisdomTree has 4 different strategies available to European investors. The first one we launched was actually artificial intelligence. That was back in December of 2018. Cloud was second. We launched it in September of 2019, so little did we know what was going to happen going forward at that point. Then in February of 2020, right at the start of the worst equity market downturn, I think, in history, we launched a battery solutions strategy, which has generated a lot of interest of late with all the focus on the environment and ESG and some of those concerns. And then very recently, the end of January 2021, we did just launch a cybersecurity specific strategy. So those would represent the 4 that WisdomTree currently has.
Okay, thanks for that. Do you think that the risk in global equity markets is likely to increase this year, and how would that impact thematic investments?
Absolutely.
Yeah.
You look at what's already happened, and it's sort of funny to think about this, because if you measure risk in different ways, you kind of get a different answer. Like we saw last year, I think some of the highest readings on the VIX index ever, but you sit there and it was almost like if you blinked your eyes, the downturn was so fast and you got back up to the prior levels in the market so quickly that you almost wouldn't even recollect that you saw some of the highest volatility in history. So
Right.
There's what we saw last year. What we're seeing this year, it feels a bit different because we just experienced incredible returns, markets at or near record highs for these extended periods. Tech market stocks, cloud market stocks just, could do no wrong. The growth was unbelievable. So all these things are coming together, and now we're basically saying, what's next? You might have that recovery, interest rates may go up, inflation might go up. What's going to transpire? And it's very difficult to answer that question. So it's almost like now there's a different type of risk where the leadership in the market, it's sort of signaling that we think, based on our trading moves and the different sectors that are performing, we think tech has led the market for long enough, and it might be time for other cyclical sectors or parts of the real economy to lead the market. It remains
Right.
to be seen if that actually plays out. Growth versus value, that's a big discussion as well that sort of touches on that. But it could definitively feel much more risky this year than the 110% returns that we saw in cloud last year. I think that's a pretty safe assumption.
And Chris, we've just got time for a question from the audience, picking up on that
Sure.
theme of risk. From Richard, who wants to know how many of your investment target companies are actually making a profit at the moment?
So it's basically, if you think on positive free cash flow, we've tended to see something on the order of 60% of the weight of the index that has a positive free cash flow, looking back through the live history since we've been doing this. Positive profits, definitively lower. It's been around 25 to 30% of the index at a point in time, basically profitable. So obviously you saw in the presentation and the slide, the big focus was the revenue.
Right.
That's sort of chapter 1. All the companies want to experience what Zoom experienced, where I think in 2019, profit was maybe 20 million or something close to it. And, you fast forward and you multiply that by 10 or 15 times in 2020 because of the scale that Zoom achieved.
Christopher, thank you very much. We're going to leave it there for now, but we'll catch up with you a bit later on this morning.
Good morning.
Good morning. Good to see you.
How are you?
You'll be talking a little bit about portfolios and how they should prioritize natural resource equities. Is that right?
Correct.
Great.
Correct.
Well, I'll hand over to you for your presentation, and we'll have some questions for you just after.
So good morning, everybody. My name is Noel O'Halloran, and I'm the Chief Investment Officer at KBI Global Investors, based in Dublin. As you can see, I'm from my home office this morning. In terms of who KBI are a specialist boutique equity manager. We're part of the Amundi Group, who are our majority owner since 2016. As of this morning, we manage about $12 billion in specialist long-only equities. We have our home office in Dublin, a team of about 62 people, and we also have an office in Boston. And as you can see from this slide, we have a very global client base spread from Asia to Europe to the Americas. And importantly, and something I'll touch on today, from a responsible investing perspective, we have a very long history and lots of accreditations when it comes to responsible investing. So what I was going to talk about today is natural resource investing. But from my perspective, to bring natural resources with a difference. So when people historically think of natural resources, they speak of oil or natural gas or coal or sand or metals or mining. And that's where many investors today are invested and have been invested. For us at KBI, it's much, much more about looking at the future needs and the three key natural resources of the future from our perspective, which is water, clean energy, and food. And this is a journey we started on back in 2000. And clearly all are sustainable, which is a difference. So what drives that? I think this slide really shows, I suppose, the journey where it started from our point of view. So I think Chris talked about mega trends. So for us, this is a mega trend that it will bring multiple decades source of alpha for investors. There are, from our perspective, what we call 5 indisputables driving the alpha opportunity when it comes to these 3 key natural resources. And those 5 indisputables are, you can see the kind of macro drivers. What's common to water, to clean energy, and to food is that all 3 have insufficient supply, they have increased demand, and increasing regulation. So they are sort of, if you like, the problems out there. In terms of the solutions, and this is what I'll talk a little bit about today, the solutions will be very much driven by increased infrastructure spending and increased spend on technological solutions. And that leads us to what you can see at the bottom of the page, to put some color on it. If we talk about agribusiness, if we talk about water, or if we talk about clean energy, you can break that down into sort of 9 segments, some of which become much more apparent to people over recent years, such as in the renewable energy space. We're now very familiar with wind and solar. 10 or 15 years ago, that wasn't the case. But also within the water industry, there's lots going on the technology side. Again, it may not be as sexy as some of the topics that get discussed these days, but it is, believe me, very sexy when it comes to the water industry, which is an absolute need for each of us on our daily basis. So that's the sort of setting the scene in terms of the long-term alpha opportunity. If I just run a parallel journey then, this is the World Economic Forum at Davos. Each year they survey the participants as to what they see as the top five key global risks. What's interesting here is I show this slide from 2011 to 2020. What's great is then the deep blue, you can see as of the last 4 years, 4 of the top 5 current risks as seen are all related to either water or energy or climate change in general. If I showed you the previous decade, I believe there was no dark blue. So global leaders up to 2010, if you like, were in denial. What's important from our perspective is that today, our journey and the sort of global journey have merged, and therefore society in general today understands that there are major issues out there. Companies understand it, governments understand it. And why is that important? I suppose it's important because when governments and companies get it, they are finally spending money on it, which helps the companies that we invest in. And I think the other point I'd make just for the forum today is that investors are also getting it. So over the last 5 years in particular, we have seen a major acceleration in interest in these strategies, particularly from retail investors, foundations and endowments, pension plans, and sovereign wealth funds. So it's really paralleled, I suppose, with the sort of World Economic Forum findings. And to put that into some context, I call this the yet slide. And you can see when we talk about water, only 1% of the water on the planet is available for use, yet water demand is going to grow by 40% by 2030. When it comes to the clean energy space, fossil fuels has become public enemy number one. It's become climate change enemy number one. We have a problem there, yet energy demand is forecast to grow by 50% by 2050. And then finally, just when it comes to land, we all know, as with water, that land is a finite asset out there. It's scarce, it's not going to grow, yet food demand is going to grow by 65% by 2050, not least with a growing global population. So to bring that together in the core of this slide, I talked earlier on about solutions. So here we can see in infrastructure investment alone, forecast for water, power, and agri. You can see the figures for yourself. So there is massive spend, roughly 40 to 50% of total global infrastructure spend is actually going to be spent on water. In this case, power includes, it's roughly 70 to 80% clean energy and 20% in traditional energy and agribusiness. So this is, when I talk about mega trends and tailwinds, that's why we're so excited about talking to you today about natural resources with a difference. So there is a problem, clearly, insufficient supply, rising demand. And the next slide really shows you, I suppose, from a portfolio perspective, how we would build or suggest building a solution to some of these problems. And this is sort of just a visual in terms of how a natural resources portfolio could look. So there's four ways that you can match this supply demand issue. You can either increase supply, you can decrease demand. You absolutely need to improve and assure quality, as we've seen, and I'll come to some examples. And then finally, and per the previous slide, we absolutely need to build and repair infrastructure. So infrastructure has become a major, as I say, politicians finally getting it, industrialists finally getting it, and you're seeing, surprise, surprise, a big green energy bill coming out of Europe in the last 12 months. One of the top issues in the Biden presidency is clearly an infrastructure bill when it comes to green energy. We're seeing the same in Japan, in China, right across the world. So this is a terrific vector, I suppose, from our perspective. And just to talk about a couple of the themes on this slide, I mean, I kind of break out those, these are the solutions as such. So people get it. If you're going to have more water, well, you can either desalinate or else reuse the water you have. If you're looking in the middle of this slide in terms of smart grid and energy storage, improving quality, well, ask Texas right now. They certainly would like to have a smarter grid. When it comes to power transmission on the right-hand side, ask California last year with the fires, particularly on the west coast of California, where they pretty much lost the entire power grid. If you want to talk about leak detection, just come to Dublin or any big city. 60% of our water is leaking today. So there is a major infrastructure issue, an already scarce resource leaking through the ground. So this is where, this is very tangible, understandable types of solutions that we speak to. On professional farming, just to mention the ag side a little bit, go to California. I'll show you in a couple of minutes the impact side of professional farming, but this is all about water scarcity and solving that, better seed applications and better energy production on the farm. So from an investor's perspective, I think I just talk about three things that people look for. Firstly and foremost is alpha. So there's no point in investing in this unless there is alpha. We absolutely, as I said, believe there's mega trends and mega tailwinds here that will drive multiple decades of alpha, and that's already been the case in many cases from our perspective. The reason is better earnings growth potential and ultimately superior growth combined with attractive valuations. I think the other thing from a client perspective is diversification. You're getting very high active share versus broad market exposures. A bit like the previous speaker, and in this case, you broadly have about a 1% overlap with the MSCI World Equity Index. So this is truly different. And then finally, and very importantly, whether you believe in ESG, which thankfully most days, most of our investors do, but some are deniers. If you are a denier, I say you're getting ESG and impact for free. If you're somebody who truly believes in this, it's absolutely embedded in these types of strategies, which I'll go on to speak about. So 3 components of what these strategies would bring from a client perspective. This is just a slide. I suppose it's a deeper dive into solutions that might come to just building out a clean energy infrastructure or a climate change solution that some clients have asked to. And again, it's tangible. It shows you the kind of the mega trends in the left-hand column. It shows you the theme that you would be playing, and then some examples of stocks that play into this theme. So as I said at the beginning, KBI, we're a specialist long-only equity boutique. So these are all listed equities, daily priced. But in terms of some of the trends that are out there, we're just showing you in the clean energy space, which has clearly been a very strong area in the last couple of years. We could equally show you a similar chart in terms of water. The water industry is far less sexy, I suppose, than the energy industry. It's many of the companies on our water portfolios will be around for over 75 years, whereas clearly when it comes to clean energy, that may not necessarily be the case. The third point I spoke to was just responsible investing. I think it is important to show what that means, because it means different things to different individuals. From our perspective, it's a holistic, as on this slide here. It's ESG integrated at the 6 o'clock position, right up through active ownership, which is important to clients. So both voting, engagement, all of those are expected by clients these days, and something that we deliver in these types of natural resource strategies. And then as we go to the sort of 2 o'clock and 4 o'clock position on this slide, what's really grown in recent years has been clients saying, yeah, I get it, I want the alpha, I take that, but I also want to know what's the impact of these strategies. So I will get onto that more specifically in a minute, but this is from our perspective the sort of RI journey that you need to see from a client perspective. I would say 3-4 years ago, when people asked about, give me an example of the impact of your portfolio, it was quite a qualitative discussion. And it still is to a large extent, because we need to explain qualitatively what types of impact your portfolio is having. We should just show on this slide for your reading later on, sort of 9 or 10 different examples of impact from a thematic perspective. So I've already commented on precision agriculture, but that is having very strong impact when it comes to needs for, say, usage of fertilizer or water or crop chemicals, very, very efficient usage in those cases, and so on and so forth. Clearly on the renewable energy side, again, you can, and we all see every day how much of our grid is being produced, the energy is being produced from through the grid. So that's the traditional measurement of impact. From a qualitative perspective. At KBI, we're now into our 4th year of this, we pioneered a quantitative assessment of impact as well, which many of our clients really like. And this is what we call our revenue aligned SDG score, or RAS score, where basically we measure the impact, the revenue impact to the SDGs of our portfolios, both positive, negative, and neutral. And basically from a client perspective, in this case, it's one of our strategies, we will be able to say to you that 74.7% of the revenues of the underlying portfolios are positively aligned towards achieving the UN SDGs. And you can see on the top of the page what percentage is aligned to each of the SDGs. So clearly water is a reasonable component of this portfolio. So SDG 6, 16.5% aligned to water. So that's about it, Christopher. From my perspective, I think I just wanted to give you an introduction to natural resource investing with a difference. I wanted to tell you a little bit about who we are at KBI, and I think just from a client perspective, again, there is an investment case for natural resources that has three components of alpha, better diversification, and also very strong responsible investing characteristics. So I will leave it at that, and hopefully there's some questions.
Noel. That was really interesting and thought-provoking, and at times really very concerning. The challenges facing policymakers around the world, of course, is enormous. One of the figures that struck me was the 1% or less than 1% of water globally that is available to use, and the 40% increase in use that's projected in a very short space of time. It's one of those things, I think fair to say we all take it for granted without a second's thought, but it's a big issue. No, I'm going to leave it there because we are short on time, sadly, but there will be opportunity a bit later for question and answers, so we can come back to any issues we want to unpick there, but I'm going to leave it just for now. I'm going to introduce our next speaker, David Coombs. I can see that you're there. Good morning.
Good morning.
Morning, how are you?
I'm good.
Great. I don't have details of your presentation to hand, but you're going to be talking a little bit about Rathbone's strategy, I believe.
I'm going to give. I'm going to talk about the markets the last 6 months, rotations, technology, all sorts of stuff, current trends in the markets.
That's great. Over to you.
Okay, so around the world in 15 minutes. But what I thought I'd really focus on today is, we're in a world of huge volatility right now. It may not feel like it at the index levels, but there's huge stock dispersion, asset class dispersion, partly due to the great news or good news that we look as if there's light at the end of the tunnel with regards to the pandemic. And so what the markets are trying to do is work out, is this good news or bad news? Because as most of you listening on the call this morning will know that, markets recovered last year, right? We had positive returns in all our funds last year from 10% down to about 4 or 5. And it didn't particularly feel like a bad investment year at the end of the year, although I guess there were certain markets that were less positive, like the UK equity market, for example. But generally speaking, it didn't feel like much of a crisis at the end of the year in terms of investment markets. But we've seen that volatility return with a vengeance in Q1, and that's because the markets are trying to work out, are we in for the biggest economic recovery on record, and which is going to cause huge push up in inflation, which would then cause a big push up in yields, which would cause government indebtedness, unemployment, and a pretty doomsday scenario. So from this great news, since we've had the vaccine news sort of beginning of Q4 last year, that's created a lot of wobbles, as we've seen. And many of you will know, we've seen a lot of the big winners of last year, the COVID winners, if you like, which were particularly in technology, healthcare, etc., significantly underperforming. Tesla off from $900 down to below 600 yesterday. And you've seen that across the piece. It's been pretty savage. And if you're in front of that, you've had a pretty painful Q1. So it seems such a shame, doesn't it, that I had my vaccine last week and felt quite euphoric when receiving it and thinking that actually we might get back to normal. And there's been lots of hype about what does the new normal look like. We all work from huts in our back garden to the end of time. Some pretty excitable claims of how the whole world's going to move on its axis. No one's ever going to fly again, stay in a hotel, or drink a flat white. So I'm going to try and sort of look through the noise and try and make some sense of this as I go through my presentation. So, as we head back towards normalization and we peer out from our homes again and decide to go to the pub or the restaurant or even fly Ryanair, although I didn't do that before the pandemic, so I'm not planning to do it afterwards. But what is that going to look like? In my view, we will definitely have a surge through the second half of this year. It will depend which country you live in. I was on the phone to somebody in Australia yesterday. they're pretty much living as normal, other than no one's allowed to enter or leave the country. But day to day, they're going to nightclubs and pubs and clubs, etc., etc. In the UK, obviously, we're still in some kind of lockdown, so there'll be a big surge come the summer. Already, you cannot book a cottage, caravan for a holiday in the UK through the summer, so we're seeing huge demand. Prices are going up, and this is what's causing that inflation. Europe, because of its more slow rollout of vaccines, probably slightly delayed. US, I was talking to somebody in New Jersey last week. Again, New Jersey, the pubs are open, restaurants are open. There are parts of the states that are a bit more locked down. So it's a very mixed pattern. So what I can definitely say is you are going to see prices rise from sort of June through to the end of the year, probably across the Northern Hemisphere. And that is going to fuel these inflation concerns. We've already seen that. Now, long term, I don't think inflation is a major structural issue. I still think we've got this huge increase in computer power year on year, which has been hugely disinflationary, has pushed wages down for the last decade or more. I don't think anything's changed. If anything, all COVID has done is accelerate this. We're not getting younger as population since COVID. We still have aging population. Most of the trends in place, the rise of China on the global economy, it's all the same. To me, COVID has changed everything but nothing. Okay, it's just accelerated all those trends that we had already. Obesity crisis, Northern Hemisphere, tick, it's still there. Will we sort it? Don't know. It's still a big factor affecting government expenditure. So for me, yes, we may work from home 1 or 2 days a week. We may buy our coffee from a cafe on the high street rather than in London. We may not go on the tube as often, or or whichever city you live in. But ultimately, I don't see huge long-term wages pushing up. In the public sector, frankly, governments can't afford it. In the private sector, there's going to be still huge disruption that was already in place before COVID. But we have seen this huge rotation, haven't we? Over the last few weeks and months. Now, as a multi-asset manager, and being Welsh, the glass is always half empty. In fact, it's usually got a hole in the bottom. I'm always nervous, always skeptical, always worried about losing money. I always start from a place that I don't want to lose money, right? So when we got through to the summer last year, and Amazon was at $3,300, Tesla was at where it was, all these tech stocks flying high, hyped up app stocks, as I call them. I got very nervous. The valuation differential between US small cap and large cap, mega cap, has never been as high, or certainly not for many decades. And this was flashing red warning signs for me, purely from a risk perspective. I'm still a great believer in tech long term, although I don't own Apple or Tesla, but I do have other tech stocks in the funds. That made me very nervous. That rotation risk, how cheap oil companies become. Oil was almost $0 a barrel at the front end of the curve last year. It broke 70 yesterday, right? But think back to summer last year. People were talking about delivering tankers in the high street because nobody wanted it, right? And where were we going to store this stuff? Banks were on the floor. There was huge valuation differentials, and it didn't feel right. So we rotated our portfolio to our equity part of our portfolios into being overweight oils and financials. I cannot tell you how uncomfortable that felt. I was sat in meetings and people tell me that oil is stranded assets, they're worth nothing for longer. And listen to some of the earlier presentations, you can see why, right? It just doesn't feel right. But that's the way multi-asset works. You have to usually be trading when it's uncomfortable. But also a spike in the oil price is hugely risky for global growth of the company profits and margins. So we're always worried about a sudden rebound in the oil price. So we don't market time, but when the oil price is at zero at the front of the curve, your kind of basic maths is telling you that at some stage that may well move back up, given there's a lot of interested parties in having a higher oil price. So we did that rotation as a risk management exercise, not market timing. And of course, August was far too soon. But what it has meant that during Q4 and Q1, we've been much more resilient than many of our competitors, particularly the passive space, actually. And on top of that, being able to hedge sterling, which was still sort of in a post-Brexit malaise last year, has also helped us reduce risk during Q1. And it's often when multi-asset strategies come under sort of most scrutiny is during periods like this. And the point is that you can't pretend you know what's going to happen next. Okay, so now my top holdings are Schlumberger and First Republic Bank of San Francisco. 8 months ago, that would have been probably Amazon and Aptiv. So the portfolio has changed considerably. We have to evolve. So let's just quickly talk about inflation. And as you probably gathered from the picture on the right-hand side of your screen, you know, I am not in my 30s. In fact, I was growing up in the 70s, and inflation just seemed like something that happened all the time. It was part of life. It's only now when you look back and you see actually inflation was a blip in the 70s and 80s. And over the last centuries, you know, inflation hasn't really been a major issue for economies. And so a lot of us are still anchored back to those days of the 70s and 80s. Certainly those fund managers and strategists of similar kind of cohort to me, sort of harking back to the glory days of the 70s, not. But things have changed considerably. I mean, that may seem obvious, but clearly we didn't have the internet in the 70s. But also, economies were run very differently. If you think back to the UK, or those who are too young, Google it. You know, what happened to the coal industry and the in the 1970s? People were put out of work for decades. We didn't retrain people very fast. Okay? And that's going to be the same again today. We've got lots of people in the gig economy who are either unskilled or do not have the skills necessary for an economy that's going to be driven by technological revolution, which is what we're in the middle of. So I cannot see where wage pressures are going to come from, sadly. And unfortunately, as we've seen since the global financial crisis in 2008, you know, we've seen a bigger gap growing between those that earn and those that earn particularly well and those that don't. And unfortunately, without government intervention, I can't see that changing. Now, certainly, Biden's appointment as US president does change the narrative slightly, and we need to, you know, handing out checks in the middle of a pandemic. You know, we need to see if that continues. But at the moment, it's very hard to see how we're going to get wage growth. I mean, look at the arguments in the UK at the moment, for example, over nurses' pay. You know, they're getting rewarded through their bravery with a 1% pay rise. So inflation needs wage growth. I cannot see where wage growth comes from. We will see price rises in the middle of this year, but I can't see them sticking, to be honest. The other point that people mentioned with regards to inflation is reshoring and bringing manufacturing closer to markets, because as we saw from the PPE debacles in the Northern Hemisphere last year, all of a sudden having manufacturing close to market seems a little bit more necessary than it did prior to COVID. Again, this was a fact that was already happening pre-COVID. Brexit being one factor, where more and more businesses, international businesses, were looking to move some manufacturing into the UK to be closer to that market in case of supply issues coming across the continent. I met companies like Packard and Estee Lauder that were completely reviewing the way that they dealt with the UK market, but also with regard, more importantly, on a global scale, you know, the whole issue around cyber security and the reliance on so many industries now by the Internet of Things, sensor technology, the internet, and bringing sort of higher value and higher value manufacturing back within their own country for safety and security. Yeah, that is a multi-year event. That is nothing to do with COVID. Is that inflationary? Yes, it is slightly, absolutely, because it will be more expensive to manufacture some of these products in the US, for example, than in China. But frankly, the last 5, 6, 7 years, we've seen costs rising in China. And yes, we were seeing some manufacturing move to countries like Laos and Cambodia. But so this will be slightly inflationary, but again, I think it's a one-off. I don't see it as a long-term threat to interest rates moving beyond sort of 1 or 2% in the next 5 years or so. But the market is clearly, raging between those two forces at the moment. Is inflation coming and sticking, or is it a short-term phenomenon? And I'm afraid we're going to see that kind of that argument play out in markets over the next 6 months, and it's going to be painful both in the bond market. We're seeing huge volatility in yields in sovereign bond markets. That is going to play over to the high yield bond markets, investment grade markets, as they struggle with, you've got some very low yields. There's not much room for maneuver, and we're also going to see it in the equity market. Now, actually, what have we been doing? We've been raising cash. I've sold all my gold. I want to have plenty of powder in the portfolio to take advantage of that volatility, both in bond and equity markets, because I think I'm going to get a lot. And certainly, last few weeks we've been trading quite significantly. Are we past peak tech? I don't have a huge amount of time to discuss this today. All I would say is be careful about what tech is. We are far too quick to put labels on companies. Deliveroo is about to be IPO'd in the UK as a tech company. No, this is a takeaway delivery company that makes losses, right? The hype in markets through retail platforms around stocks that are not profitable, around companies that aren't tech companies but are enabled by technology. Uber is not a technology company, it's a taxi company, okay? I'd much rather be investing in real tech companies providing cloud solutions like one of the earlier speakers, or computer assisted design solutions, or computer microchip power solutions like Cadence, Ansys, etc., and Microsoft. That's what I want to invest, new technologies that are driving that technological revolution, not companies like Netflix or Tesla or Spotify that are here today, gone tomorrow, just being the first movers in using that technology. I'll finish on one of the other big threats there are out there right now is, government's been incredibly supportive during COVID, and that's been the right thing to do. Goodness knows where we'd be without it. But as we know from history, when governments support you, they want their flesh, their pound of flesh. Just think about the banks. In Europe, the banks are still paying the price of needing bailouts in 2008, 2009. They're still paying extra taxes, special taxes, highly regulated. They had to have it in the UK. Their dividends were stopped last year on government orders. Any company that has been supported during this crisis will be paying that back for some time in one way or another. And so we need to be very careful about that at a corporate level, but also we need to be very conscious that somehow the governments have got to pay this debt back, and they can do that through inflation, through QE, or more borrowing. My sense is it'll be more QE, and that's going to create volatility in bond markets. I'm conscious of time. I'll stop there and open up for any questions if we have time.
Thank you. Thank you very much, David. That was, as ever, very engaging, very topical, very, very thought-provoking. A bit later. I'm going to move on to welcome John Ewart. John, hello. John is co-fund manager at Aubrey Capital Management. He's going to be talking to us about the return of the emerging market consumer, looking at why country and industry development continues to provide different investment opportunities for investors, and considering some of the challenges there in terms of backing successful companies in volatile environments over the longer term. John, good day to you.
Good morning, and thank you for your kind introduction. Good morning all, and welcome to this presentation by Aubrey Capital Management. I am John Ewart, one of the investment managers with the company, and I've been with Aubrey since early 2012. Excuse me. The company was founded in 2007. We are based in Edinburgh, and as a team, we have been living in the emerging market region or investing in emerging markets for many years. Our focus is on companies that can deliver growth And I was conscious of David's comments in the previous presentation. Our focus on growth is cash flow growth. And we look to companies to generate cash in order to fund the expansion and development of their business. And being Scottish, you would expect us to have a keen eye on the valuation that we are willing to pay for these companies. I'll be discussing the opportunity for investors in the global emerging market region. And as you would expect, we have a GEM fund, which is investing on behalf of our clients in this area. But on this slide, you can see a picture of the Shanghai Marathon, which took place last November. And it provides grounds for optimism that the Chinese consumer is getting back to normal. And certainly, we're hopeful that the prospects of a return to normal will be as encouraging for citizens in many other parts of the world. So we believe that the opportunity for emerging markets is illustrated by this graphic. And growth in personal consumption is providing the structural opportunity for the GEM universe, we believe. And our strategy is built around this consumer development. More than half the world's population live within this shaded area. Asia currently accounts for approximately 40% of global GDP, but will generate over 60% of future GDP growth. And within the emerging markets universe, we believe that Asia is quite different to Africa and to Latin America. The latter two historically have suffered from populist politicians, commodity-based economies, and many years of disappointment through limited economic growth. Now, when we look at this graphic on page 3, it illustrates the wealth progression that consumers experience, and that's what attracts our interest. Quite simply, that the consumer changes their spending behavior and their consumption patterns when they earn more money. Each of these 4 countries are at a different stage of economic development, and this presents an opportunity for investors that are specific to the country and to the industry. We consistently see similar patterns of behavior as consumers have better opportunities in their daily lives. To take China as an example, GDP per capita is now over $10,000 US, and in the larger tier 1 cities, it's over $15,000 US. And whilst the consumer priority for many years has been the education of their children, obviously we had the one-child policy for many decades, recent events have highlighted the need to many consumers that they need to provide healthcare support for their elderly parents, elderly members of their family. And many consumers are now actually buying wealth management products to plan for the longer term. And this is a policy, a strategy of behavior that's being endorsed by the government. The government is trying to encourage the consumer to look to the longer term, clearly given the size of the population. By contrast, over 65% of the Indian population live in rural areas and have a GDP per capita close to $2,000 US. Now, they are obviously more focused on the basic needs of life, such as having employment that provides a modest income in order to support their rural home and ultimately provide food and basic amenities for their families. The transition from urban living to urban living will take many years, but the prospect of better housing, better health, particularly through sanitation, and a formal education will offer a much better opportunity for future generations of the Indian population. The enthusiasm of the Chinese consumer for online shopping will not be a surprise to you, but perhaps you're less familiar with the influence of the KOL, the key opinion leader, and increasingly the role that live streaming now plays in online selling in China. We recently published an article on this phenomenon, which you will find on our website if you're interested. And this page displays 2 screenshots taken from the Taobao site during the recent China New Year, shopping experience. On the left, Proya is a leading domestic cosmetic brand, and on the right, Feihe is one of the leading players in infant formula category. They're actually the leader in the premium end of the infant formula category. And the two young presenters are the KOLs who are engaging with their audience. You can see some of the live chat on the left, and this is encouraging the audience to obviously buy the products. The important trend that we have identified in China in recent years is the increasing preference for domestic company products. Clearly, international brands are very successful in the larger tier cities, but for many Chinese citizens in the lower tier cities, they are embracing the domestic champion, as we would describe them. This is simply not the function of a cheaper price. The quality of the product has improved considerably, with many of these companies having ventures with international suppliers, international ingredient manufacturers, for example. But the marketing influence of the KOL has proven to be a very effective tool. And we can also see this, interestingly, actually appearing in media channels in other areas of the world. A previous chart illustrated the change in consumer behavior as the economic benefits derive to many members of the wider economy. And it's interesting when we look at the example of Indonesia. E-commerce adoption is now accelerating in Indonesia. And yet again, we have seen the impact of a smartphone, an affordable data package, and what this can mean for the behavior of a large, young, and predominantly urban population. 25% of the 260 million Indonesian population is between the ages of 15 and 30, and they have been enthusiastic online buyers. This is a screenshot of the Shopee site, which is owned by Sea Limited and is the most popular e-commerce shopping site in Southeast Asia. Demand continues to accelerate. The consumer is clearly embracing the shopping experience. And importantly, domestic small businesses are now having the opportunity to supply a much wider customer base via e-commerce, which clearly has implications for their own viability and growth. Tencent of China, a name many of you will be familiar with, were an early investor in Sea Limited, and they own 26% of the equity. We as a company, Aubrey, invested in Sea Limited in early 2019. These are the structural shifts that we see in the behavior of the consumer, and we expect this to accelerate and incorporate a breadth of products and services that we have seen elsewhere in Asia in recent years. The success of Alibaba and Tencent, the depth of their product and services clearly provides a future guide for the growth of these businesses. Where does India fit into this expectation of economic and e-commerce development? Clearly a large country, 1.4 billion people, similar to China, and expected to continue to generate growth, required to generate growth in order to provide employment for the many generations to follow. China's GDP per capita was at the Indian level of $2,000 approximately 15 years ago, but China's been successful with their investment program in areas such as infrastructure, transportation, education, and the development of many new industries, including electric vehicles of late. This is the challenge for India, to replicate that to some extent. There are many excellent Indian companies, and management adapted to the challenges of COVID over the last 12 months, and there are two examples provided here. Titan is the largest jeweler in the country and have been very creative with their interaction with clients, offering online presentations of jewellery and arranging opportunities to wear the products at home before ultimately enticing the consumer to buy the product. And they believe that they have actually accelerated the process of online adoption of jewellery shopping. And interestingly, given the expectations of pent-up demand in the developed world, you're also seeing this in many countries in the emerging world. Weddings are clearly a big deal in India, and with a lot less opportunity for people to actually go on holiday or go to weddings, they have been treating themselves, as you've seen also in many of the developed countries. So Titan have benefited from this. The second graphic is clearly a pizza, and the company concerned here is Jubilant Foodworks, which is one of the leading food delivery companies in India and the operator of the Domino's pizza franchise. Unsurprisingly, deliveries of pizza have increased during the last 12 months, but almost 50% of Jubilant's pre-COVID sales actually took place in the store in seated eating areas. Eating out is a family phenomenon, clearly, but eating out for pizza in a takeaway company is perhaps different to what we expect when we look at the contrast with some of the European economies. The challenge for Jubilant was to utilize the customer data to offer personal incentives and to innovate the menu and replicate that dining out experience. And the company has actually been successful in doing so, and they've delivered impressive operating performance over the last 12 months. And again, they're highlighting the e-commerce growth opportunity that the last 12 months has actually brought to their business. So two examples of companies which have taken the last 12 months and embracing the opportunity that e-commerce has to offer in a country where clearly there's not as much of an infrastructure or wealth as we've seen in the development of China over the years. So I'm hoping at this point that you're asking the question, as was posed by our host at the beginning, is the opportunity for the consumer delivering results if one is adopting that strategy for investing client money? And is there a longer term structural opportunity for investors within global emerging markets? And we would clearly argue that the answer to that question is yes. And this performance chart illustrates the returns that have been generated by the Aubrey Global Emerging Market Fund, and you can see that illustrated with the green line. And we compare that to the MSCI Emerging Index, one of the blue lines, but also two of the consumer indices, staples and discretionary. And importantly, we are generating alpha for our clients through stock selection. Over 80% of our returns are generated by stock selection rather than country or sector allocation. At the present time, we do define the opportunity set widely. At the present time, we also have exposure to industries such as healthcare, such as education, such as home ownership. And the point that we make about the opportunity in emerging markets is you have to look at the right sector in the right country, and clearly you have to pick the right company. I'll close on this slide, which is a snapshot of the Aubrey team. Just a quick comment on the individuals. We are all analysts, despite the varying ages that you will see in those photographs. Being an analyst is our day job, and that's what motivates and enthuses us in terms of actually being together as a team. When we're back in the office, there'll be a lot more interaction in terms of looking at travel opportunities. I have to say, over the last 12 months, many companies in the emerging market universe have been excellent in making themselves available for conversation, for discussion, which has clearly been to the benefit of us having to work from home. And my colleague Myra, details are highlighted here, and Myra will actually be available on the panel for additional questions and discussion. Thank you for your interest.
Thank you very much, John. Very, very interesting presentation, I'm sure, for all the audience. I just have time, I think, for a couple of questions. Do everyone feel free to, as I said, add your questions to the panel. I'll do my best to put them to the presenters. John, just in the first instance, I was wondering, while you were speaking, a lot of people are talking about inflation and the risk of the return of inflation generally in the world, even in developed countries. But what is that likely to do, if it's going to happen at all, to emerging markets?
It's always the great concern in practice. I think David's comments earlier regarding the prospect of inflation being quite limited at the moment. India is the one country where you always have reservations, partly because they are an oil importer. Clearly, we're seeing the oil price increase, and if there was a weakening of the currency, then that is the one risk, and India's dealt with that in the past. I do think that at the present time, the concerns do tend to be on food inflation rather than a structural increase that we're seeing. And even in countries such as China, which is clearly still growing and obviously has good employment prospects if you are educated and you're looking to work in the cities, the prospects for wage increases do seem to be quite limited at present. Which is in contrast to what we have seen in recent years, where certainly wage growth certainly seemed to be quite a feature of the job market.
I'm just looking to see if we've got any more questions coming in. Any thoughts about, is it time for in any way reflation trade in emerging markets? What would that entail?
A reflation trade?
Yeah, that's what we've got here.
Oh, I see. Possibly. I mean, clearly the oil price, as was mentioned previously, is a factor that will influence certain industries in certain emerging market countries. I would highlight that our strategy is very much focused on the consumer. We do not invest in oil companies or commodity companies generally, and we're very wary of involvement of the state in businesses. The companies that we invest in are predominantly set up by individuals, entrepreneurs who have not had the benefit of access to state banks in many countries. Therefore, they've had to provide their own financing and growth of the business itself. But I do think that what you are seeing in recent instances, for example, in Brazil, where there was an attempt to increase the price of fuel and the president intervened and effectively reversed that. And clearly that has implications for investor confidence in what's happening in that country. But in the larger economies, the governments are certainly conscious of the impact of higher fuel costs, higher food pricing on the disposable income of many segments of the lower end of the population. So there are subsidies in many of these countries, and I would expect that to continue to happen. I don't see a rampant inflation environment, but I accept that there certainly has been an element of the so-called reflation trade. But interestingly, if you actually look at bond yields in many Asian economies, we're not seeing a spike in bond yields that we have been seeing in developed markets.
Right, yeah, that's interesting. So everything to look for at the moment in the world of emerging markets. There's a lot of...
It's not quite the Goldilocks scenario, but we're seeing growth in China. We're seeing the prospects of recovery, and inflation is not yet a concern. So that let's hope that continues. You know, the longer term structural opportunity of people getting wealthier and embracing many of the goods and services that we take for granted in our daily lives is the dynamic that we really focus on.
Okay, that's great. So basically, before we move to announcing the awards, I wanted to tell you a bit more about Sharing Alpha, just to set the stage and tell you about the methodology behind the awards. So for those of you who are less familiar with Sharing Alpha, the idea is to offer professional fund buyers a chance of building up their own personal track record as fund selectors in a similar fashion that fund managers have a track record. It's the only platform that basically offers that feature. The way it works technically is that we invite professional fund buyers onto our platform, and they're asked to select a number of funds that they're familiar with. There's around 200,000 funds on the platform, so there's plenty of funds to choose from. And then they're asked to select a number of funds that they're familiar with and to rate them in terms of their future chances of generating alpha. And what we do next is we compare the ratings they've assigned with the actual performance of the funds that they've rated. And if there's a match between their ratings, their expectations, and what happened in reality, then they receive a high ranking from us. So from this process, we end up with two separate lists. One is the list of top ranked fund selectors in different countries and regions like the Nordics, which I'll present in a couple of minutes, and also a list of top rated funds in different investment categories. The best way to basically describe what we do is using the headline that the Financial Times used to describe what we do, which is where Morningstar meets TripAdvisor. That's how they describe Sharing Alpha. So we create the outcome of this process is that we create a TripAdvisor experience for funds. So if you go to a fund page on Sharing Alpha, you'll see the ratings that the fund received, the people that rated the fund, the commentary that they left about the fund. So really kind of, again, a TripAdvisor experience. And we launched Sharing Alpha actually almost 5 years ago, April 16, and we've become the world's largest community now of professional fund buyers. We have thousands of members from 77 countries. I've shared, let me share it on the chat. I'll share a link to Sharing Alpha that you can, as you're in front of your computers, if you want to visit Sharing Alpha and join this community, you're more than welcome to do so. So in terms of the features available for professional fund buyers, so it's a unique fund research experience. So you can basically not only see stuff about the fund and see what people wrote about the funds, but you can also take part. So it's more like a 2.0 experience. You can rate the funds, as I mentioned, build up your track record. So that's the second main feature that we offer, that you can basically stand out and prove to yourself or to others that you actually are doing you're adding value into this process, you manage to select the right funds for your clients. And those fund selectors that stand out, they receive quite a lot of attention. They're approached by headhunters and they receive a lot of attention by the media. So you can go and visit yourselves. There's just a screenshot of a fund page that shows, again, the ratings, the people that rated it, the commentary that they wrote, the rating over time, and so on. And these are the badges or the certificates that the fund selector receives on an annual basis both in terms of their fund selection capabilities and their asset allocation capability. Understanding of who we are and what we offer, International Investment decided to adopt our methodology in determining the winners of their awards. Very proud that they've done so. And here's a list of the 5 fund selectors in your region that have standed out in terms of their track record in 2020. The runner-up is Petri from OP Financial from Finland, head of manager selection over there. And the winner of the awards for the Nordic regions, Yanni from Ellie Bank. So again, this is a proof of the fact that the industry is adopting this methodology, because again, it's the only basically external kind of third-party recognition to the very important job that you guys are doing as fund selectors, because you're measured basically in a standard way relative to each other, which is quite unique. I'll be taking part in the panel, so if you have any additional questions to me, you're more than welcome to ask. Thank you.
Thank you very much, Oren, for that. We're now going to move to our final session, which is the question and answer panel. For that, I'm joined by Gary Robinson, who will be hosting this session with me. Gary, I don't know if you want to introduce the speakers.
Yeah, we've had some, just to finish off with the speaker section, we've had some questions, and in your program, you may have seen that the Q&A for the speakers would have come before Oren's presentation, so forgive that being the other way around. But just we've still got the speakers out there before I introduce the general Q&A panel, and I just wanted to ask a question to David Coombs that's come in directly. It says to David, you mentioned 6 months of this tug and war between growth and inflation. What events will bring the markets to lower volatility and to decide the future course? David, what do you have to say to that question?
Okay, so what will bring the markets to lower volatility? I think what we need to see is basically 6 to 9 months of the central banks reiterating their stance on not pushing interest rates up and to continuing with QE, despite the debt issuance, and that they're willing to support the domestic bond markets. With the exception of the US, many countries are reliant on external investors to support their debt markets, and this is an existential risk. So markets will want to see some comfort that central banks will buy that government debt, which I know to so many of us will seem slightly worrying, that we're effectively supporting the printing of money, but that's where we are. We are in a very different scenario to anything I've seen in my career before. And like it or not, we have become like the addict sort of to alcohol or tobacco. We are now addicted, I'm afraid, to QE until that debt is repaid, unless we're willing to inflate. And I think all central bankers will work together, because they know that will end very, very badly. So it's going to have to be actions, I'm afraid, not just words. The central bankers are already saying this, but the market's going to have to believe it. And for the markets to believe it, I'm afraid only time will prove those actions. So I think it's going to take 6 to 9 months of the central bankers holding their nerve, and for us to just wash through this sort of surge in demand that we're going to see in the summer and to autumn in the Northern Hemisphere. So I think those two factors we need to get through. Once we get through those, if we are unscathed, then I think the market will look to focus on the next thing, whatever the next thing might be. So yeah, there's no easy way out of this, right? There really isn't. So it's very hard to imagine a world where from here, which will be free of volatility.
Good answer. Thank you, David. We've got a couple of other questions that are coming from the audience. One for KBI Global Investors, and the question that we have here is, how important is longevity and in an experience in ESG investing, something that KBI have? What difference does it make? And we'll put that out to Noel, please.
Thanks, Gary. Well, I suppose it's important from a number of perspectives. Firstly, I think you're seeing from a marketing perspective a big focus these days from fund buyers and everybody else on the question of longevity when it comes to the whole topic of greenwashing, and that question as to whether this is just a new rebranded marketing story, or this is something you truly believe in and therefore it's in your DNA. So longevity, absolutely. If you have a team that's been doing it for over 20 years, I think that's without dispute. I think the other thing from a bottom-up investment perspective is that longevity is important in terms of how you basically integrate ESG, how much you believe in it, how much is part of your decision making, and how it's important with, for example, how you engage with companies or how you vote against companies or not. So that longevity and ability and track record to demonstrate that is absolutely important. And it's not either or. I think it's the final point I'd say. When people talk about ESG, it's almost like a separate decision. To us at KBI, it's not. And you know, it's a bit like the previous discussion about balances out there. So it's a balance between the value you put on ESG and the value you put on the other fundamentals in a company. You can have companies with absolutely fantastic ESG and pretty horrible fundamentals that may not be investable. And equally, you could have a company with fantastic fundamentals and really, really poor ESG that in aggregate makes them uninvestable. So to us, I think that's where that experience, having a specialist dedicated team who sort of live, eat and sleep this stuff matters. So longevity is to answer a long question is important.
It also answers, thanks Noel, it also answers one of the other questions in part about greenwashing. It's a term you hear a lot at the moment. How can investors combat this? How can those making those fund selections get past greenwashing?
Yeah, it's a question we get a lot these days, and I think the best answer I've seen from anybody out there is you know, interview the CIO of the firm for 5 or 10 minutes, and if he or she really gives you a belief and a passion and a dedication to ESG, then you'll pretty much sure that that's the culture of that company. And if it comes from the top down, then you can be pretty much sure it's ingrained there. If that's not a very satisfactory discussion, and that CIO points you to the ESG team or the head of RI or the marketing team, then it probably answers it in a different way. So I think it's that's my best answer to that for anybody, is just interview the CIO, and that will hopefully give you a pretty strong view on that answer.
Excellent, and we have done that today, which is fantastic. I'm going to just bring everybody else in at this point, and by the way, feel free to stick around. This is the part of our forum where it's quite fluid. You know, it's a Q&A, so if you want to chip in, please do. I'm going to moderate it, and Christopher will also chip in. But first, I'll just say, you know, just introduce who we've got that we haven't already introduced. We have Niall Murphy. I'm looking to make sure I get the job titles right. We've got Niall Murphy, Senior Vice President, Business Development and Client Services at KBI Global Investors, who's with us too. So hello, Niall.
Good morning, everybody. Morning, Gary.
Morning. And we also have Myra Chan, who's Sales Director from Aubrey Capital Management. Welcome, Myra.
Morning.
We've also got Ravinder Assad, who is head of UK and Nordic sales and from Wisdom Tree. Morning, Ravinder.
Good morning, everyone. How are you all keeping?
I'm good. I don't know about everybody else. I feel great.
Well, thanks for everyone's presentations today. It was really informative.
I think absolutely. You've heard from Oren Kaplan from Sharing Alpha and from Christopher Ganati, who will be staying with us as well. What was kind of nice about this debate is we've also brought in 3 of our fund selector friends, and I'm very pleased to say hello to Samuel McKaylee, who joins us all the way from Stockholm.
Yes.
Morning, Samuel.
Yeah, good morning.
And we also have Daniel Rock, who congratulations, Daniel, on your shortlisting for the Nordic Fund Selector of the Year award. And you know, maybe next time, but congratulations for being in that top 5.
Thank you.
Which is great to see. And I think we've still got Christian. I'm going to try and say this right, Christian Horner.
That's excellent.
There you go.
Very nice work.
Yeah. another one of our fund selected friends who was also in the top 5. So many congratulations, Christian.
Thank you very much.
So quite an esteemed panel, and one of the questions I want to we can talk specifically about some of the things we've already spoken about today, but one of the things I wanted to ask, and if I may, I'll start with Samuel on this. One of the things that I wanted to ask, I find of interest, is the fact we've been a part of this global pandemic. How has it impacted on the way you do business outside of the obvious? And will there be anything that you take forward from the global pandemic into your future work? Have there been any positives when you're looking and you're prospecting for fund and fund selection?
The net is becoming more important as old people have hard time to meet. They'll send their children and so on. So it kind of complicates stuff, and their kids are more worried than their parents, so to speak. So they will be coming there with the attorney of power to discuss the issues.
Interesting. And when it comes to meeting managers, you're used to the events that we've Incisive Media that we have hosted and we specialize in have been face to face. Now we're doing this, which is amazing. It certainly is something that helps cut down on air miles. But you're used to seeing people face to face. Has it impacted on your fund selector decision making? I'll ask that to you, Samuel, and I'll also ask it to Christian.
No, it hasn't. In one way, where you have certain companies like Swedish steel makers and so on that are not so effective, if there would be any disturbance in one factor or another, they're quite on high value chains sort of companies. They still go about what they do, sanctions, or tariffs with China or not. They just do what they do. So, anyway.
Thanks, Samuel. How has it impacted yourself, Christian? And have you found that you've been able to see the fund selectors that you want to see? How's it impacted?
Yes, it has impacted me a lot, and I think the whole industry in many ways. Meeting all those managers with the help of video conferences have raised a lot of questions. I don't think we ever go back to do exactly as we did before the pandemic. I think we all see the advantages with meeting a whole lot more digitally. And with that said, of course, it's nice to meet in real life. And I think we'll continue to do that, but maybe in another way than before. So I think it's many of these mega trends and tailwinds, as we're spoken about today, has gained a lot of several years during this year or this actual first couple of months during the pandemic. So it's very powerful forces, I'd say.
Now, looking at the presentations that we've had already today, in particular, Chris's earlier on, looking at the way that the pandemic has impacted, what's been your biggest positive? And I'll ask that question across the board because including to David, what's been the biggest positive from the pandemic on your offering and investments?
I kick off.
Okay.
Sorry, if we can start with Chris.
Okay. No, it's in what we've seen at Wisdom Tree is lots of focus on obviously cloud computing and other technology related thematics like battery solutions, our Bolt strategy, which ties into ESG and sort of thinking about the future of energy storage. A lot of focus on a variety of commodities, but the interesting thing about commodities is they kind of come in and out. Like when oil was going through the floor last sort of March, April, people couldn't get enough exposure to oil, and we saw billions come in. And now oil, last week is going through the roof, up in directions that many people wouldn't have expected. And, there's basically crickets compared to last year. And you saw sort of similar moves with gold, with Wisdom-Tree's strategy with Bitcoin. So you saw sort of similar moves there. So what you're seeing, it might be an influence of central banks and the liquidity in the system at various times, perception, sometimes even social media impacting how people look at the markets, is you see these big, fast shifts that can occur in certain areas. And then you sort of see these mega trend ideas that have these great stories that people can connect with. And it seems like people really love to talk about those things and to do their analysis and see which ones fit in their portfolios.
Good answer. And just straight over to you, David, on this. What have your wins been throughout this pandemic?
I think, first of all, if I look at my own business, the impact it's had, the positives, and you can extrapolate that, it's real world stuff, right? So if I think of my own point of view, I can now trade from home. So I can trade in Asia in the morning and then trade in the US at night. I'm not stuck on a train commuting 2 hours out of Paddington Station back to the Wiltshire where I live. I had a meeting yesterday with the CEO and CIO of Amphenol, who are based in Connecticut, straight into their homes yesterday. I used to travel to the States to see them. I see clients on videos, meetings like this more regularly. I'm doing webcasts, podcasts. I'm now doing presentations to underlying clients of networks. So I did a Zoom call to over 300 people a few weeks ago, everywhere from kind of Namibia to Indonesia. So the reach, and it's meant I'm more accessible to my underlying investors, not just through the intermediaries and the fund selectors who may or may not have known me. Some of those on the call today probably don't know me, but it's meant I'm more accessible to my investors. I hear from my investors more what they're interested in. So from a business development perspective, from an investment management perspective, I've got more time and I am less stressed out. I am fitter because I'm on the Peloton every day, and my mind is less full of trying to catch a train. So I think my decision making is more, how do I put it, calmer, if that's the right way of putting it. I mean, I don't mean it as in a guru type of way. I mean as in just being calm. So I think if I extract, will I go back to how I was before? Absolutely not. There have been some wins that are forever from this, from my perspective. There are bits. I will still travel. I'll still travel to see new clients. I think building relationships, you still need to be in the room, so to speak. But I think for small businesses like myself, this means we can compete a much more even playing field with the bigger guys, and that's disruptor. And so that's one small bit of how it's affected me. I think you can take that and look across many, many different parts of our industry and maybe others. And it's those subtle changes that will have quite big ripples, I think, and how we identify those. Sorry, it's a very long answer to your question, Gary, sorry. But I do think it is subtle, it is nuanced. And yes, there will be some big shifts, but I'm more interested in the longer term impacts and trends. And I think some of those I just described are here to stay.
I think it's really interesting. Just ask Samuel's call off there. I think it's really interesting because, and I want to bring in Niall Murphy from KBI Global Investors here as the impact that we've had from the pandemic. It's been seen everywhere, but the rise in sustainable investing and ESG and impact investing and all the things that you've been doing for years has been really brought to the focus. How's that been for KBI Global Investors? How have you found things during this pandemic?
Yeah, well, I think it's been an incredibly interesting time, and we went through a number of phases. I guess for the first few months, you had this concern that it would be difficult to generate new relationships because you'd miss that face-to-face interaction. Our modus operandi, like everybody else, was to meet manager selectors face-to-face, and often we had then the due diligence site visit back to our office in Dublin, and we felt that gave a real sense to the potential buyer of the culture, of the passion of the team, and it reinforced how differentiated we were. So I had those concerns at the start, but by the end of the year, I think we moved to the new normal, and it helped winning kind of business in a remote new world. From the start of the process right through to money inflows, all done virtually, with the same level of due diligence other than the physical visit to the office in Dublin. So that certainly is one element. If you're looking at the bigger macro themes, I think what COVID has taught us is that the global authorities, our policymakers, need to act in a coordinated fashion to protect the global economy and the planet. And COVID is a salutary lesson in that. But what we've seen is that the next greatest threat is climate change. And this, if anything, first of all, has redoubled the focus on decarbonization, and also the need for stimulus, which again, as Noel alluded to, has a green element to it. And all of that really has helped, for a lot of investors to look at ESG thematics and realize that there is a significant tailwind, and governments are acting differently to transition to a lower carbon society. And that in turn puts a focus on the type of stocks that the solution providers that we're invested in.
That's a really good answer. And of course, the lack of air travel significantly impacting on the planet across this last year must have had a huge impact.
Yeah, I mean, it's not all positive in terms of, you can see the benefits both personally. I'm not as tired because I'm not traveling as much. I get to spend more time with my family. I don't know if they think that's a positive, but I do. But you do miss, we're part of a larger organization, and that we're a subsidiary of Amundi. And certainly one of the things that Amundi used major on was gatherings to allow all kind of client-facing people gather together over 2 days to get updated on what the different themes were, etc. And that allowed you to build personal relationships with people who are based in Stockholm or Helsinki, because we're partnering together in terms of how we sell to the end market. And there's no doubt that it's more difficult now in this type of world, and you have to redouble your efforts to keep relationships with key people, by means of phone calls or via Zoom, etc. So there are challenges there, and I would imagine it's particularly challenging where an organization is going through a lot of change with new staff. Within KBI, we're lucky. Many of us have been around for 20 years and we know each other very well. But an organization that's going through flux, where you have a lot of new staff members starting virtually, I think it will give rise to a lot of challenges.
Absolutely. I think it's been a really interesting chat today, because the there was no particular theme for this forum. It was a range of different presentations, and there is this sort of parallel. I mean, the pandemic and COVID has kind of brought a lot of things into focus. I'll just ask a quick question to Myra Chan from Aubrey Capital Management. Just, you know, with your opportunities within emerging markets, what have you found across this last 12 months? But also, how has that impacted on digital opportunities in emerging markets? Have they come to the fore more?
Well, I think, thank you for the question. Just to give a little bit of perspective on emerging markets, I remember 30 years ago when I was in China, I looked at Pudong, and it's a vast piece of land with no buildings. And at that time, I was a commercial banker in Citibank, and we were going to finance a hotel project there. And I said to my boss, who is going to use this hotel? And today you looked at the picture that John shared with the marathon. It's filled with buildings and people. So there has been a tremendous change in emerging markets, and particularly in China. And I don't think that that's going to stop. And in fact, this pandemic has only accelerated it. For instance, we look at, I was also a private banker in Citibank just before I came back to Europe a few years ago. And, you know, the target customers we had, the entrepreneurs, we categorize them into various groups. There are those who are in the older generation, like in their 50s and 60s. And there are amazing stories of them breaking bricks and, you know, started out as a hawker or a construction worker, and suddenly within the context of 20 years, they suddenly became a millionaire or billionaire. And then there are the younger entrepreneurs in their 30s and 40s that you will hear more about today. And they are the ones in the high-tech industry. And they are the ones who are very well-educated engineers, and they, you know, they make it because they have worked in the likes of Google, Microsoft, and now they are coming back to China to start their version of the tech business. And so I think that this pandemic had only accelerated that. And in fact, in the emerging markets in China, we see that the consumers are back because actually things are really back to pretty much normal, other than stopping them from traveling. The restaurants are open, and you know, we get pictures of our family and friends going out as usual. And so I think that the trend of going into technology, the trend of consumers asking to improve the quality of life, that's not going to change. And so I would say, I would agree with David, is that the pandemic actually didn't change course, but in fact, it just accelerated a lot of the changes that was happening.
I think that's a good point to make. Just this is an open conversation, so using Zoom, you can raise hands virtually with. So if anyone's got any points they want to make, you can use the little yellow hand at the bottom of your screen, and also if you want to type in any questions. Christopher may jump in. I get questions that are coming through from the audience. I'll carry on with those. But if Christopher wants to jump in with any that he's picked up as well. Just one for David Coombs from Rathbones. One of the questions that we missed earlier was, is there anything, you're a multi-asset investor, is there anything that you won't hold in your portfolio in particular? And that question goes out to you, David.
There's lots of things I won't hold. I mean, to be honest with you, the most important investment decision ever is what you don't buy. Actually, it's far more important than what you buy. Because what you don't buy is often things that go horribly wrong. Hopefully you don't buy those. So I'll give you some examples, right? So we don't invest in businesses we don't think have a model that will be relevant in 2 to 3 years or will be open to government intervention. So that takes us out of sectors like fast fashion, payday lending, gambling, etc., etc. Even sort of car insurance, business models that we think have some exploitation either in the supply chain or with consumers. So that trendily is called ESG these days. To me, that's just common sense and good business and etc. I also will not invest in hyped up asset classes like Bitcoin. To me, Bitcoin has no legitimacy as an asset class. It is still far too open to criminal intervention, and until it's regulated, which is kind of, in a way, it would be the opposite of what it was invented for. It's uninvestable for me, and I wouldn't put my own money in it. I never invest in anything I won't put my own money into. So I always get very nervous about things that get hyped up in markets, and I'm usually out of those. Bitcoin in particular really worries me because I think it could trap a lot of people in there who can't afford to be. So that's just a couple of examples. There are many areas that I will definitely not invest in, but for time, I'll leave it there.
Thanks, David. And you probably couldn't get a more general question, could you? It's almost like, what things don't you hold? Well, the entire world apart from what I do hold. So a really good and succinct answer. I'm sure we don't want to dwell on this, but just out of interest, and I'll ask this to the fund selectors actually, and this is purely for me. Do David mentioned Bitcoin there, or cryptocurrencies. Is this a serious investment? What do you do when somebody says, "Hey, my friend made all this money on Bitcoin. What I want to do something with it." What do you say to them if they ask you that? And I'll start with you, Daniel. What do you say to somebody that talks about Bitcoin?
Yeah, sometimes I get that question, but since I don't know anything about it, I'm frank with my clients and telling them that I'm not doing Bitcoins.
That's a good answer. And I've had this debate before. It tends to be possibly younger people that go for that. I'll just quickly ask Christian, what about you with the Bitcoin question? Have you heard it before? Are people asking?
Not so much actually, but maybe I work as a discretionary portfolio manager, so and it's not a part of my assignment, so I'm sort of released from that question. I guess my investment advisors get that question asked a whole lot more, yeah.
Oh, thank you for that. But Samuel, just a really quick one. What about you? Are you hearing that question?
Yes, I have had that question. I said, okay, you asked the guy who earned money. Why don't you go and ask the guy who lost money? So
there's plenty of those.
Yeah,
it's I suppose what's interesting is just to see what your answers to those questions are, because it's always interested me.
I don't know so much about Bitcoin, so if somebody wants to talk about it in depth, I will explain that. But as Bitcoin is a thing where people, like a lottery kind of gamble, they have to have that mindset in order to. That's why our answer would be, well, have you asked another person that lost?
Yeah, that's good. That's a really good point. And I think the volatility side of it, it's obviously incredibly difficult to predict. Myra, you've got your hand up.
Yeah, I want to tell the person you must have made already 100%. So take out 50%, put that in a classic case of like Yale endowment, portfolio, balanced portfolio, asset allocation. Ask David about it, and put your pocket of money of 50% into different portfolios, including, of course, emerging markets.
That's fair. That's fair enough, and a good plug for emerging markets. Speaking with speaking earlier, Chris and Ravi, what you're in the ETF world. How does that work? Because there are, the cryptocurrency ETFs that are. Does this thing exist? Is it something that you guys get involved in? If so, why? And maybe put that to Chris or
Sure.
Ravi, either or.
Sure. So in the ETF world, the first thing that I think of things as is there's this giant toolkit with now probably a few hundred, if not over 1,000 different options for investors to choose from. And ultimately, those options are across the entire spectrum already. So on the spectrum, there are things represented, not necessarily that WisdomTree has, but just represented generally that are more risky even than Bitcoin. And then there are things on the other end of the spectrum that are almost the same risk profile, risk-free, like a cash-like investment. And so what we try to do is we try to bring more and more tools to the regulated market. And I liked the comment earlier in the sense that if there's someone out there that's trying to just say Bitcoin went from 4,000 in March of 2020 to 60,000 in, say, January, February of 2021, and the only reason I'm investing is because Elon Musk tweets about it, this is probably not the most worthwhile of investment theses. However, if there was a path to have just a regulated option trading in markets where people could then study the return stream offered by cryptocurrency and think, what's the correlation to certain other asset classes and how do I compare to this or that, then you might have a discussion, at least, which won't always lead to someone allocating. It's certainly not, no asset is appropriate for every person, but in the end, it could represent a new tool in the toolkit that could be brought to regulated markets. Ultimately, most things that we buy today, except gold, which has been around for thousands of years, at one point seemed new or seemed crazy. I mean, we go around with pieces of paper with numbers on them, and we ascribe value to those pieces of paper. And if inflation comes, then those pieces, we're going to need a lot more of the pieces of paper ultimately on a unit basis. So in the end, in the grand scope of history, everything was new at a certain point, and it's important to study those options. And of course, we are much more a fan of things being in the regulated markets as opposed to unregulated.
No, that's a really good point, and one that David made earlier. Thanks to that part of it. I mean, that's kind of slightly unscripted, but it's an important question that does get asked by investors. I just want to ask a quick question on impact investing, and this is to KBI, and either Niall or Noel can answer this. What's we spoke before about the increased focus on sustainability and ESG investing. What's this increased demand in impact investing, and what are the key issues that are associated with impact investing? And maybe if we ask you that, Niall, first.
Yeah, I mean, I think it's self-evident in terms of that more and more investors want to ensure that the companies in which they're investing are having a positive impact on society, on the global economy, on the planet. I mean, ultimately, we're all working to try and and generate pots of money that we will spend later. And the key point is the world has to be a better place for us in 20 years' time when we draw down on that pension pot. And if we have climate change, and if we have poor societal or labor practices, etc., that evidently won't be the case. So what we're saying is, and it's coming from the most sophisticated investors in the world, like, for example, AP7 had a green impact equity mandate. We were lucky enough to be one of the successful parties. But also you're getting millennial investors. And we're seeing this particularly in family offices, where the younger members of the single family offices are now as concerned with impact as alpha. So the challenge then is, well, how do you demonstrate impact? Because if you have a portfolio of companies and say water is a particular area you want to focus in on, you might find only 30% of them actually produce a sustainability report, which says last year we instigated measures that saves 5 billion liters of water. But then the second element is that each company will have a different methodology. So that's the massive challenge you face in impact measurement. I mean, to some degree, in the world of carbon emissions, the world has overcome that, because clearly under scope 1, 2, and 3, there's a standard methodology. So the challenge is more disclosure and some form of uniformity across that disclosure. And what we have done is, recognizing that it's a significant challenge, we have used the UN SDGs as our framework in which to try and produce a portfolio-wide measure. So it's certainly not perfect, but it's a start. And we know that our investors are reassured then when they're looking at metrics at the end of the year. Number one, what's your return been to the portfolio relative to a benchmark? And number two, can you outline an impact measure? And in that case, we're clearly stating that, you know, as a result of a lot of analysis, we're saying that 70 to 80% of your portfolio, the revenues attributed to activities within those companies, those activities are positively aligned to the UN SDGs. So it's one way of looking at impact. But it's a massive challenge, but it's certainly an area where we're seeing a lot of interest and growth.
It's a really good answer, and one that I think is very, very pertinent. I asked a question before about standing out in the marketplace, and in many respects, the Nordic region has been very supportive of of sustainable funds and ESG funds going forward. I'm just noticing one of our fund selector audience members has asked to put their hand up and asked a question, and I'll read this out if that's all right. It's a question to Chris Ganati. It's easy to see the value created by cloud business, not so easy to attach the right multiple to the stocks representing the cloud opportunity. What methodology do you use for choosing the right multiple when making your buy decision? It's quite specific, Chris.
Yeah. No, it's a great question, and ultimately, it's very challenging. So to know the right multiple ahead of time, my team and I, we don't have a precise or exact methodology to do that exactly. It's made tricky by the fact that if you think of the Zoom case study, in December of 2019, you basically have roughly 30 million daily active meeting participants logging on each day. And 4 months later, you have more than 300 million daily active meeting participants. But it's odd because Zoom really didn't have to make or do anything different besides maybe paying a bit more to the cloud computing infrastructure providers, the likes of Oracle and Amazon and the others, to handle the load of traffic. In the end, when you make software, whether it's used by one person or a billion people, it's still there, it's software. And what's happening across the world, we heard the emerging markets presentation as one example, is software is becoming more and more ubiquitous. And history doesn't have that many examples of something you could make in effect one time that can just be copied and used by a billion people in fairly short order. And that's really where the cloud companies sit and what they represent. Ultimately, the pertinent question that's coming in a lot of times today is, after 100% returns, 110% returns last year, what should we expect, or what should we do now? And I like Myra's answer before, where you basically say, you got 100% returns, you have to reallocate, you have to rebalance, you have to think of your long-term goals, your asset allocation. And with cloud, it's no different. Because if you said, okay, 2020 is 110%, you expect another 110% in 2021, the answer really is, I wish, but probably not. You know, a long run growth rate of revenue for these companies should coalesce somewhere around 30%. That's kind of where market expectations are. So if you look at last year, Zoom was compounding revenue for the quarterly basis year over year at about 350%. So what the market is going to see is year over year growth of revenue coming down from 100% plus in certain cases to a figure, depending on the company, that's going to get closer and closer to 30%, at least in the medium term. And so 2021 could be a transitional year, but the key is to always think long term, is cloud the way we are all going to be consuming software? We think yes. Our expert partner in the space, Bessemer, thinks yes. And so ultimately, we think the space could still be attractive if in fact that thesis is true.
Thank you on that, Chris. Now, we heard briefly earlier from Oren Kaplan, and he very thankfully came up with this rather amazing platform where fund selectors are able to rate funds. And Oren, I just wanted to ask, for those that know about it, you'll have already heard about it, and hopefully they're already rating funds. But this is a double-edged sword. This works for fund selectors, and it also works for the fund management companies. How is that? How does that work? And how is it a win-win on across the board?
Sure. I mean, the market is very inefficient in the way that buyers and sellers come together. Investors and fund selectors, fund selectors and fund providers traditionally come together in events that are not possible anymore, and through all kinds of other channels which are not very popular in other industries because they're very inefficient. And for some reason in our industry, most of this interaction is still done using those very inefficient ways. So what we offer is an alternative in the sense that the fund selectors can go on to Sharing Alpha and look at the funds that are recommended by their peers. I mean, every other product and service out there, the way that people select those products and services nowadays is looking at peer reviews. That's what drives a lot of trust and a lot of these search activities. And we're offering the same kind of mechanism in the fund industry or the asset management industry, and especially in the conditions that are prominent today, where the travel is restricted and people have less informal interactions with each other, a chance of discussing different investment opportunities, and so on. It's very it's one of the reasons that we've grown so strongly last year is because this is a digital alternative to something that was done traditionally face to face. So the way it works, basically, as I said earlier, is that the fund selectors can go and view the funds that have been highly rated by their peers in different investment categories that they're interested in. And then we show them a list of funds that might match their requirements, and they can highlight the funds that they want to hear from. And that way we generate leads for the fund providers and relevant investments, potential investments for the fund selectors. So it works for both sides of the table, rather than just bombarding fund selectors with emails and invites and stuff that they don't want to hear about. Actually letting them know about stuff that they are interested in.
Thank you, Oren. That was a good answer and quite succinct. It's just from the fund selector point of view, you've said you're the largest database in the world of fund selectors. That's pretty good going over the course of since the launch. How many years ago was it since the launch?
It took us, we spent 4 years without earning anything. We just went out to the community of professional fund buyers through different channels. The media love what we do, and event organizers like yourselves. And we went out. LinkedIn has been very useful, and told them about this. Told them, why don't you come check out Sharing Alpha? It's a free tool for you as a fund buyer. The earlier you start building up your track record, the better, because that way you'll have a long-term track record. So 4 years of hard work, gathering thousands of them to come and register on the platform and start building up their track record. Now that we're monetizing it, it's much easier, but it was, it's very tough. I come from a background similar to the people on the panel where, you work a couple of months and you end up generating some kind of revenue, either by, managing assets of investors or clients. In this case, I had to spend like 4 years just, speaking to people and counting users. Everybody told me on the internet, that's the way it works. You have users and traction, you'll end up making money. But, when it's a story about Facebook or, other platforms to hear, but when it's your personal life, it's not easy. So it wasn't, abracadabra and we had thousands of users and traction. It took some time. And now with the Corona situation, it really, we're enjoying exponential growth in terms of interest from both parties. But we started with the hard part. We started with the demand side, identifying the demand, getting their attraction, getting their attention, and now we're bringing on board the supply side, the fund providers.
Thanks, Oren. Very, very briefly, just out of interest, what's it like within the Nordic region? Do you have a good following out there?
So as you saw, we have some leading fund selectors in the region that have joined. Still a lot of room for growth. But I can say that roughly 75% of our investor base are based in Europe. So we're now just starting to grow in North America, in Asia. It's predominantly, it's a global platform, but it's predominantly European fund selectors. So including the Nordics, obviously, but there's, I'd be happy that the attendance of this conference and their colleagues will also be part of the community. I think, as I said, there's only an upside, and people working in the financial world understand that we're giving out basically a free option for them. If they're successful, then they can, basically present their achievement. If they're not doing that well, they can learn from it, but we're not shaming anyone. So we're not showing the track record of fund selectors that have a mediocre track record. Unlike fund managers that are out there with their track record and have nowhere to hide, in our case, it's a private account. So they understand that it's a free option. There's only benefits from joining Sharing Alpha, and that's one of the reasons that we've been successful.
Thank you, Oren. Myra, you have another point to make or a question for the panel?
Yeah, it's half point to make and half question, because I just want to, KPI mentioned earlier about the rating on ESG, and I do think that there is a need for convergence of different methodologies. And I wonder if at some point in time, this kind of, Oren's TripAdvisor kind of open platform will be able to play a role in, creating a common language in the ESG space. And the comment I would like to make is that ESG is definitely no longer just a rhetoric, because I was also very doubtful whether ESG, will become the core concern of Asian investors. And recently I talked to some contacts there, and I am very encouraged to tell you that, in fact, there is a platform there created already, incorporating, I think, 27,000 funds with an automatic generation of ESG score for all the funds on it. And the way they do it is by filtering down to the portfolio companies that they own and giving them from that an ESG score. So it's based on obviously looking at the listed companies' ESG score, which is, there's no consistent standard worldwide, but at least it's a start with some better disclosure than what we had before. So I must say that Asia has this tremendous capacity to leapfrog experiences we have seen elsewhere in the world, and perhaps ESG is becoming fast reality there.
Thank you for that. Do you have, Niall? Do you have anything to add to what Myra has just said?
Yeah, I mean, it definitely would be a positive development if there was more uniformity. You can pick up 2 or 3 different ESG ratings of a fund, and they can be dramatically different. But it is complex. You know, like from our perspective, philosophically, we prefer to engage with poor ESG performers and encourage them to improve their ESG performance. And we think there's an alpha and societal benefit from doing that. So if you take a company, a traditional energy utility that is on a transition or glide path towards generating far more renewable than fossil fuel electricity generation, we like those types of companies. But if you invest in them and you're engaged with them, the problem is that your ESG rating, if you're using carbon intensity metrics, for example, may not be great because of that. Yet we think it's the right thing to do. And the other element is that you're seeing these national labels come in different countries across Europe, and from that perspective, these labels sometimes focus on exclusion rather than engagement. So, you know, there's a lot to it, but we would certainly welcome more uniformity.
Thank you, Niall. I'll bring in David, who wants to add to this, and then I'll go to a raised hand from Ravi at Wisdom Tree. David, what would you like to add?
Yeah, I think so. You know, we are currently literally a couple of weeks launching our sustainable multi-asset funds, and the last 12 months I've been working on this. And what has absolutely astonished me is how poor the definitions are around ESG, around impact, around sustainability, all responsible investing. All of these words now bandied around incredibly loosely, in my view. And I was kind of horrified by some of the poor quality of ratings, poor quality of these definitions. There is really, and even the EU taxonomy stuff is still pretty vague. A lot of the products out there obviously coalesce around the UN SDGs, which themselves are quite vague and can be interpreted in many, many ways. There is no shortcut here. I think one of the other panelists was saying you've got to engage directly with the company, you've got to understand the culture of the company, you've got to check what the revenues are, what percentage of profits. There's lots of virtue signaling out there. I mean, a lot of corporate virtue signaling. They all get it. CEOs know if their share prices to continue going up, they need a good ESG score. So these guys are very good at presenting. They're very good at saying we're good at ESG, and they'll roll out their head of ESG or chief information officers or whatever. And there's a huge amount of BS. And I think there's no shortcuts at the moment, I'm afraid. You've literally got to kick. It's old fashioned, but you've got to kick the tires, and you've got to keep kicking them. And you won't do it in 1 hour meeting. You won't get it from reading the annual report or what reports they produce. There's a huge tick box culture around this, with many people offering services in terms of engagement. There is no fast track. There is no easy answers. Okay, there's no shortcuts. And it costs money to properly run money in this way. And you just can't rebadge old stuff and stick it out there. So I think it would be very helpful if the regulators, if the industry bodies got together to come up with some definitions, but I suspect it's not going to happen in the next 3 to 5 years because it's too much self-interest.
Just we've got a couple of raised hands. I will come to you, Ravi, in a sec. But Oren, very, very quickly, because we've only got 5 minutes or so. Can you you want to make a point on this too?
Yeah, since a lot of it is required in order to analyze a fund, as just mentioned, the alternative that we offer, which is a user-based rating platform, where we take the collective view of a large group of professionals, I think is the only way forward. If you ask each individual fund selector working in silo to analyze, there's, as I mentioned, just 200,000 funds on our platform. If you ask them to analyze that amount of funds or focus on even hundreds of funds and do it on a consistent basis and do it properly, that's impossible. So the only way to do this kind of analysis, embedding also ESG, is to use a collective kind of approach. So one of the factors that we have, that we ask our fund selectors to rate, is the ESG policy of the fund. It's one of the factors out there. So that's I think the way to do it properly. I don't see a way of of doing such qualitative analysis individually.
Thanks, Oren, for adding to that. I think it's it's a lively debate. I want to, because Ravi's had his hand up for a while virtually with the Ravi, what would you like to put to the panel?
No, thank you very much, and good job it was virtually, otherwise my arm would have got tired by now. No, but I think everybody's made some really kind of valid points, and ESG is a very difficult one to kind of grasp sometimes. I mean, speaking to clients for kind of 15 years about this topic, it's been very difficult for them to kind of define what ESG means to them. I think what we have been finding, however, is that particularly last year, for example, where we saw probably north of around $7 billion of kind of new money flowing into kind of European domiciled thematic ETFs, where investors are trying to play those ESG kind of stories within themes. So maybe there's certain themes that are trying to tackle the environment or tackle the social governance issues. Without kind of plugging too much. I think last year we found a lot of investors focusing on the social governance side of ESG, where they were looking at cloud computing and maybe seeing, well, how are employees being treated by their companies during this pandemic? Are they being laid off, or are they being looked after a little bit more kind of eloquently? And this year, potentially with such a focus on the environment, and with transportation being such an easy target and a big pollutant, a polluting activity, shall we say, we can see that there are themes that are being followed by investors that can tackle that particular side of ESG. So it's very interesting how people, I think about ESG, but then actually how they invest their money when they're looking to get exposure to ESG.
That's a really, really good point, and thanks for being patient there. Christopher will come back in a second to round up the session. And just before we move off this topic, I just wondered if you had anything else to add, Niall. Just one of the points that came to my mind was something you said, or something we talked about earlier about being in it a long time. I know Rathbones have been a company that's been in this market for a while, as have you guys. Is there anything you'd like to add to the current debate on on ratings and rankings within the ESG world?
Not particularly, just to echo David's point about the amount of work that you need to do. Our portfolio managers use travel extensively because we have a narrow universe of stocks that we're covering. It allowed them to have this in-depth knowledge of these companies. And again, some of them small cap based. We had a significant shareholding, which gives you somewhat of a voice. And when you talk to the portfolio managers, when they're getting factory tours, when they're looking and asking for information about accidents, about ESG practices, etc., and deciding that they themselves want to be the arbitrator of the ESG score rather than using desktop research. I think it's a valid point that there's a huge amount of effort needs to go in. And on the part of fund selectors, they need to separate the wheat from the chaff. The players that really have that commitment, that have done the research, to the ones that are just using desktop research.
Well, that's a really nice way to end this chat. And I hope you've enjoyed the fact that it's been a fluid debate. One of the things that I think we miss about face-to-face events is that opportunity for that kind of interaction around the table, yeah. And by having fund selectors and and fund managers and investment companies together, I hope that you've enjoyed that debate, as I hope our viewers have as well. This isn't for Nordic Forum 2021. There will be a feature on international investment, and there will be an edited version of the video of this that will be on our website soon. So thanks everyone for participating. I'll just hand you back to our editor, Christopher Copperinger, to round off today's event.
Thanks very much, Gary. Thank you to all of you, all the speakers, for joining us today. What's been a very thought-provoking discussion this morning. As Gary mentioned, there will be a video that you can access again if there were parts you missed or you want to revisit. My thanks again to our sponsors, Aubrey Capital Management, KBI Global Investors, Rathbones, and Wisdom Tree. And we look forward to seeing you back here again before long. Thanks very much.
Thanks, guys. Take care.